Hey, this is Darren from Property Prosperity. Today I thought I'd have a bit of a chat about minimising tax. I think that's it seems like a lot of people spend their whole life just trying to work out how they can avoid tax. And I just thought I'd let you know, that's not the most important thing. I know you go and see your accountant once a year and they go, oh man, you're paying too much tax. And you're thinking, oh man, the tax man keeps taking money out of my pocket all the time. How can I stop paying too much tax? I'm earning too much money. I think people are just focused on the wrong thing. Rather than working out looking at minimising tax and paying tax is a bad thing, I'd probably more look at it as paying tax as a good thing, because basically if you're paying tax, that means you're making money, really. So the more tax you pay, the more money you're making. So it's not such a bad thing. So I'd focus my advice to people when I'm talking to everyone, because I talk to a lot of people. They're like, oh man, I don't want to make money on this deal because I'm going to have to pay heaps of tax on it. But you only pay tax after you've made money. So if you're purely focused on not paying tax, then you wouldn't want to make any money, and you wouldn't, which doesn't make any sense at all, really. So a lot of, hey, Ashley, thanks for joining, and thanks for the like, I appreciate that. So yeah, a lot of people are way more focused on minimising tax than they are on making money, and that's where a lot of these property spruikers and a lot of these, investment groups and a whole pile of these different things where they come in there. They're selling you products that are focused on minimising your tax rather than selling you products which are focused on making you money. And I suppose that's where people get distracted. Because on paper, you can show things look really good on paper, because you can, buy a property and then claim with depreciation benefits and negative gearing and all that sort of stuff, which really looks good on paper. But what it's ignoring is capital gains. So sometimes it's at the detriment of the value of the house going up over time. And the thing to people to understand is not about minimising your tax. It's not even about, people are focused on positively geared and negatively geared and putting money in your pocket. Because in reality, when things are, negatively geared, this means it's basically costing you money to own the property. So it might cost you $100 a week or whatever. When things are positively geared, you're probably making $50 or $100 a week. So in the scheme of things, you can't retire out of, $50 a week or $100 a week. Where things are going to make a big difference is when the property goes up in value. When they talk about people, properties doubling in value every 10 years. Remember we looked at one of my other episodes, if you missed it, we looked at the statistics over the last 20 years. We showed that about the annual growth is around about 7%, which equates to about properties doubling every 10 years. So if you're looking at that sort of as a bit of a guide, remember that's over the whole market, so I'm sure not every property is going to double in value over 10 years, some are going to increase by more. But if you look at that property doubling up over every 10 years, that's when you can really start to set yourself up for retirement, because you've got all this extra value you've built up. And so, if you buy one property and it's doubled in value, or two properties and three properties and four properties, before you know it, it's putting more and more money in your pocket. And then all you have to do is sell a few of those properties, pay down your debt, and then you've got these freehold properties, and that's when you're setting yourself up, because then they've, that rent you're getting in, say it's $300 or $400 a week, times that by 10 properties and they're all freehold, that's $4,000 a week. So that's really going to change your life. So, a lot of people would more focused on, I don't want to have one or two or three or four or five or 10 properties because look at all the tax I'll pay. But the thing is, if you start doing that and focus on making profits first and then minimising tax second, I'm not saying don't minimise your tax. At the end of the day, if you can pay less tax is a good thing, but focus on profits first and minimising your tax second. So I've got Ashley is just give me a comment here, so thanks for responding. And if anyone else has got something else they'd like to say or comment on what I'm saying, then feel free to put a comment in the comment box. Is it good to buy a second home for investment with equity of the existing first home, or just focus on paying the first? So is it good to buy a second home for investment with equity or existing first home, or just focus on paying off the first home? So again, that depends on if you're focusing on minimising tax, then again, I would just do whatever makes you feel comfortable. A lot of people like the idea of paying off their house. They feel a lot more secure about paying off their house. But remember, if you're in a situation where the income you're earning means you're going to pay off your house over 30 years, that's a long time you're going to wait before you've paid off your house, before you buy that second investment property. And the opportunities you might have missed out on that over time. Because remember, by the time you retire, if you've got one house, it's probably not going to make a big difference to your retirement. Your nest egg, I suppose. You're going to need a lot more properties than one or two properties. So again, you've wasted 30 years of your time trying to pay off that property. That's, and obviously you can try and pay more money down and pay it off over 7 years or 10 years or 15 years or 20 years or whatever it's going to be. But it's still a long time to try and pay off that property. The other thing so that's what I'd firstly be looking at is if you're putting in towards your home has been, it's more of a luxury item, I suppose. You know, your house you live in is because you want to live there. It's a nice place to live. It's not an investment. You know, you're not doing it to make money. You're doing it because you live there and you want a nice house. So if you're focusing, what you should be doing is trying to put your money into something that's going to make you money. And so that's what an investment property is, or starting up a business, or putting it into shares, or whatever, really. So by putting your money aside and putting it into your home, it's a lifestyle choice rather than an investment. So understanding that if you're not putting your money aside for an investment, then you're not setting yourself up for retirement. So that's one of the reasons I'd probably try and save some of that money rather than trying to pay off your house. I'd put it into an investment property, because that investment property is going to give you a return. And again, remember, we talk about properties doubling every 10 years, and again, it doesn't always happen on average, but let's say that happens on average. You know, if you're trying to pay off that one property and it doubles in value every 10 years, that's great. You've built up some equity, but you know, imagine if you bought 2 properties or 3 properties, or in that 20 years you've been trying to pay your house, you bought 20 properties, and if those 20 properties double in value, that's when it's really going to change your life. So I'd probably advise, get out and get investing in properties rather than trying to pay down your house, because your house is a lifestyle choice, whereas an investment property is setting yourself up for retirement. So likewise too, depending on where you're from, I think Ashley's from New Zealand, but in Australia, if you can claim a tax deduction on things that you are spending money on to get your return. And so if you have a business, basically everything you spend money on is to give you a return on your investment, so you can claim a tax deduction and all that. If you are buying shares, then you might be able to claim a tax deduction on buying some shares. Or likewise with an investment property, you can claim tax deductions on an investment property. And so, so if you refinance your existing house, then you can use that money then to go and buy a property, and then that additional money you borrowed, the interest you pay on that money is tax deductible. Whereas the interest you pay on your house is not tax deductible, because it's not for what the tax man calls an income producing purpose. So when you're paying interest on your house, it's a luxury item, so you can't claim it back as a tax deduction. Whereas when you're paying interest on your investment property, then that's tax deductible because you're doing it to make money. So the tax man's going to let you claim a tax deduction for that. So the good thing about tax deductions for investment in property, or in Australia at least, and that's why they're recently discussing whether they want to change it, is you can claim the full tax deductions for depreciation and negative gearing and all these complicated things. That it's not that complicated. Maybe watch one of my episodes where I explained how it all works. But basically you can claim these tax deductions, but if you hold the property on for more than a year, then if you sell the property, you pay tax on the profit you make or the gain in the property, but they give you a 50% exemption, so they only tax you on half that gain, or half the taxable income, they'd say. So let's say the property went up from $400,000 to $500,000, so it's gone up by $100,000. The tax man's only going to tax you on half of that value, increase in value, so they only tax you on the $50,000 rather than the $400,000. So the cool thing is you can claim the full tax deduction for your depreciation and negative gearing benefits and all that sort of stuff, but you're only paying tax on half the gain. So it's like you're getting this bonus, so it's a really cool thing. So hopefully that's made sense. So Asley's saying thanks, yes, makes sense, and please let me know when you're live with tax deductible episode. My tax deductible episode was a while ago. What I am doing at the moment is I'm actually transcribing all of my videos, and I'm going to turn them into articles. So hopefully then I'll be able to refer you back to some of my articles which actually talks about the things I've been talking about. So that's probably for a future date, who knows when, but I'm slowly working away on that at the moment. So if you've got any things you'd like me to talk about, like I said, I'm happy to answer any of your questions, and I'm happy to, I'll turn it into articles, and I'll be able to send it through to you next time. So I look forward to talking to you guys again soon, and yeah, thanks for your likes and thanks for your comments. I look forward to sharing with you some more information. Thanks guys, have a good day.